Hello and good afternoon, everyone. We'd like to welcome you onto this month's event on holding companies. It's great to host everyone today. Great to see so many coming on. My name's Angus Brewer. I'm a consultant here at Oldfield, and also on the panel this afternoon we've also got Jack Bennett, one of our tax consultants. We're here today to talk about holding companies and explaining what they are, what they can be used for, and when you might need one. And we'll also cover some of the key tax considerations in having a holding company in your structure, and then also some practical points of how to get the most out of it. So first off, before Jack is going to go over some of the reasons for having a holding company in your structure, let's have a look at what one is actually in practice. So a holding company is a separate parent company created, and what it does is owns a controlling interest in subsidiary companies. So normally a holding company itself doesn't do any trade, but it owns shares in companies, subsidiary companies, which they will often be doing the trade. So let's just look at a diagram on this. So I guess in a standard limited company, usually you'd have individuals as the shareholders of your trading limited company. But what happens with a holding company is basically it's almost like this personal shareholdings moving up a level. So you've got a trading company which is then owned by a holding company, and then the individual shareholders as individuals are shareholders in the holding company. So I guess this type of diagram that we're showing on screen is what we would typically refer to as a group structure. And there are certain things that can be done within a group structure as opposed to having multiple standalone companies dotted around the place that you might own as individual shareholders. So if you need multiple entities, there can be some advantages and a bit of a neat way of consolidating those in together as a group structure. Part two to a holding company, and the concept really is allowing businesses to separate the trading risk. So you've got trading risk in the trading companies, but then you can separate that from the valuable assets and also the shareholders' personal investments, which are held in the holding company. Obviously, there's quite a number of extra and additional things and outcomes that we can use a holding company for, which Jack will cover in a minute. But just to really focus in on this protection point, I like to think of it as a bit of a barrier of protection from your trading company by having that holding company in there, and you can see that on the slide there. So I guess you might say, well, what do you really mean by a trading risk? Well, I guess trading companies, we're in business, they do come with a general inherent risk that a company could be sued for goods or services provided. There could be some customer claims, there could be some employee litigation claims, and these risks are actually real. In practice, if the company didn't have enough cash or enough assets to settle its debts, then the company could actually be forced to sell its assets and may not generate the expected level of proceeds as if the company was naturally sold or those assets was naturally sold. So I guess what normally happens in that situation is the proceeds generated would be used to pay off the creditors, the company, and then shareholders, what's left for them is only literally left what's in the pot at the end of all of that. That might sound a bit extreme, but I guess what we're really saying is the holding company is a way of business owners using it to separate those trading assets versus those valuable assets. If the worst was to happen and the trading company was sued or some claims against it, only the assets of the trading company can be liquidated and the assets in the holding company are protected.
Each circumstance and business is unique in how these taxes can impact the transaction. Each business, each property, and each restructure are unique, and they will have their own particular variances. I suppose the point to make is that before you take any action in relation to any of the scenarios I've gone over or similar scenarios that you might be facing, you need to get good quality professional advice in relation to your restructure and to make sure you're definitely working that in the best way. I think it's really important to highlight that the tax consequences on these transactions can be significant. So for example, if you've got a VAT liability on a commercial property worth £1 million, that's £200,000 of tax. or if your company is worth £10 million, for example, then you could use an alternative route to restructure your company that might save you stamp duty of £50,000. So we're not talking about small amounts here. We do unfortunately see situations where proper advice hasn't been taken, and not only can it leave missed opportunities, but it can also incur significant tax liabilities. We had a situation recently where they actually had a whole host of potential tax problems that they weren't even aware of. I mean, to start off, none of the shareholders qualified for business asset disposal relief, and they'd lost a lot of their group relief for capital gains tax, stamp duty, land tax, and inheritance tax. And just to put some context around, the business asset disposal relief problem alone came with a potential tax cost of £400,000. So hopefully this has helped to really highlight some of those scenarios where a holding company can be effectively used in your structure to really achieve the aims and objectives of the shareholders involved.